If you've been following real estate news lately, you've probably noticed something. It's all over the place. One headline says the market's crashing, another said it's still red hot. And problem is, most of that information is national, and it doesn't apply cleanly to Greater Philadelphia. Over the past 5 years, we've helped almost 700 buyers, sellers, and investors navigate this exact challenge. And what we've found is simple. The people who understand local market data make better financial decisions than the people who simply rely on the headlines. So in this video, I'm going to show you the 3 most important market statistics to pay attention to and how to actually use them to your benefit. Why national data misleads you. Here's the first thing you need to understand. Philadelphia doesn't move the same way as the rest of the country. Yes, national trends influence us, obviously, but usually later and often less dramatically. For example, when some West Coast markets were seeing homes sell for 30 to 35% above asking, in Greater Philadelphia that number was often close to 10 to 15%. And even within our region, there's a split. The city behaves differently than the suburbs, and sometimes one zip code behaves differently than the next. So when you hear the market is hot or the market is slowing, you have to ask, where exactly? Because real estate is hyper local. The 3 metrics that actually matter. Number 1, days on market. This tells you how long homes are taking to sell. It's usually a strong reflection of the supply-demand curve at work. But what matters most is the trend. If days on market are going down, sellers are gaining leverage. And if it's going up month over month, buyers are gaining leverage. And here's the nuance most people miss. Different price points behave differently. A $400,000 home and a $1.5 million home in the same neighborhood can move at completely different speeds. The second thing I want you to pay attention to is absorption rate, commonly known as months of inventory. This measures supply versus demand. Specifically, how long would it take for all of the homes to sell in a given market based on the number of homes sold per month over the last 6 months? Here's a general breakdown. If it takes 0 to 4 months to completely sell through a market, we're in a seller's market. 4 to 6 months is a balanced market. And 6 or more months, we are strongly in a buyer's market. If you're in an area with 1 to 2 months of inventory, you're likely dealing with heavy competition. If inventory rises and absorption rate slows, leverage is shifting over to the buyers. The number 3 thing I want you to pay attention to is the list to sale price ratio. This tells you what homes are actually selling for compared to the asking price. 105%, sellers are winning. 95%, buyers have room to negotiate. This is a real-time comparison between seller expectations and buyer beliefs. This is one of the most practical metrics because it shows real outcomes, not opinions. What a hot market actually looks like. A lot of people describe the market using vague terms like hot or cold, but a truly hot market has specific characteristics. Homes selling in single-digit days, extremely low inventory, sometimes just weeks, and multiple offers becoming the norm. Sale prices consistently above asking. In this kind of environment, buyers may need to stretch, but that doesn't mean abandoning discipline. It means understanding when competition is justified and when it's not. Why different price points feel like different markets. One of the biggest sources of confusion right now is this. Some buyers feel like the market is insanely competitive, while others feel like things are slowing down. And both can be true. Entry-level homes often move faster because more buyers are entering the housing market for the first time. Luxury homes, smaller buyer pool, and longer timelines. And when interest rates rise, it creates a bottleneck. Fewer people are selling, fewer intro homes hit the market, and competition increases at those entry-level price points. So you're not imagining it. What's most important is that you know how to use this data. For a buyer, if a property's been sitting longer than the average days on market, that's a huge opportunity. You may be able to negotiate price, repairs, and terms. And for sellers, if your home sits longer than the local average, buyers start to gain leverage, as you can see. And that's why pricing correctly from the start is critical when days on market are increasing. Because once you fall behind that market pace, it becomes harder and harder to recover. When do you need this hyperlocal data? General stats are pretty useful early on in the home search, but once you're serious about making an offer or listing your home, you need hyperlocal data, because zip codes hide behind block by block differences. And we can identify individualized market trends because price ranges behave differently and market conditions can shift in 30 to 45 days. The more precise your data, the better decision you're gonna make. If you're thinking about buying or selling in Greater Philadelphia, the next step is simple. Request a hyperlocal market report for your specific neighborhood and price range. You can do this by clicking the link in the description or contacting us via our website. We'll walk you through exactly what the numbers mean for your specific situation, so you can make a decision with clarity, not guesswork. At the end of the day, the market isn't confusing because it's unpredictable. It's confusing because most people are looking at the wrong data. Once you understand what to look at and how to interpret it, you gain leverage. And that's what leads to better decisions.